Despite two separate diplomatic signals that briefly lifted markets, this week ended with Brent crude, frozen hiring data, and a rate-constrained Fed pointing toward the same stagflation scenario. The S&P 500 posted its fifth consecutive weekly loss. Recession odds on prediction markets climbed from 23% to 37%. The week's story is not about any single event. It is about three separate pressure systems: energy, labor, and monetary policy, converging at the same moment. The Hormuz closure is not priced. The Strait of Hormuz remains closed. That one fact underlies nearly every market move this week. Physical barrels for near-term delivery traded at $141.36, a spread of $32 above the futures close that signals the forward curve is disconnected from actual supply conditions. Energy Aspects founder Amrita Sen and Chevron's chief executive both noted that financial markets are masking physical tightness. Diesel in Europe reached $200 per barrel. Jet fuel doubled. Fertilizer and petrochemical costs rose sharply across global supply chains. The diplomatic headlines produced genuine moves. Trump's comments about a possible U.S. withdrawal sent crude briefly below $100 and lifted the Dow by 1,000 points in a single session. But crude did not stay below $100. The strait did not reopen, and Iran's stated negotiating floor, which includes closing all U.S. military bases in the Persian Gulf and a new toll regime for Hormuz, indicates the distance between a ceasefire headline and an actual settlement remains large. Every additional day of physical closure adds supply damage that takes time to reverse, regardless of what futures contracts price. The Fed has no good move. Building on the same supply shock, the Federal Reserve finds itself in a position it cannot trade out of through conventional tools. Cutting rates to cushion slowing growth risks reigniting inflation. Raising rates to suppress inflation risks crushing demand that was already fragile before the energy shock. Fed Chair Powell acknowledged this directly. The central bank's tools have no meaningful effect on supply-driven price increases. Fed Governor John Williams described risks to inflation and employment as balanced, language that describes paralysis more than policy intent. Foreign central banks sold more than $90 billion in treasuries over 5 consecutive weeks since the war began, bolting a structural premium onto long-term borrowing costs. A proposed defense budget for fiscal 2027 is projected to add nearly $7 trillion to national debt over 10 years. Bond yields are being pulled in both directions simultaneously, higher by oil and tariff-driven inflation expectations, lower by growth fears, and neither force is close to resolving. Hiring froze before the shock. The labor data this week carried a warning that the market has not fully absorbed. The February hiring rate fell to its lowest level since the pandemic closures of April 2020, and that reading predates the worst of the energy shock. Job openings declined, but mass layoffs are not driving the freeze. Employers are not adding, workers are not quitting. The market simply stopped moving. Navy Federal's chief economist noted that in 2020, the halt had an obvious cause. Businesses were physically closed. This time, there is no such explanation. The freeze arrived under its own weight, before gas averaged $4 nationally, before the full tariff stack landed. If March's jobs report, the first full month of data inside the energy shock, shows a second consecutive decline, the stagflation reading becomes very difficult to dismiss. AI Capital Consolidates. While oil dominated macro positioning, a parallel capital story unfolded in technology. Nvidia placed a $2 billion direct investment into Marvell technology and opened its NVLink Fusion interconnect to third-party silicon, converting a proprietary fabric into a broader platform. The move validated Marvell's custom silicon and optical interconnect capabilities in a single transaction. CoreWeave simultaneously secured an $8.5 billion GPU-backed loan, the first AI hardware financing to achieve investment-grade ratings. Oracle announced thousands of layoffs the same week to redirect capital towards its own data center build-out.
Principal Asset Management noted an unusual divergence. Nvidia and Apple outperformed defense equities during an active military conflict. Defense names have already priced geopolitical risk and are waiting on procurement timelines and budget cycles. The SpaceX IPO filing, at a valuation potentially approaching $2 trillion, illustrates the broader logic. By the time large technology platforms reach public markets, most early value creation has already been captured in private rounds. Tesla's Q1 deliveries came in at 358,023 vehicles, down more than 14% sequentially, while Chinese rivals posted strong March numbers. The EV thesis has migrated entirely toward robotaxis and autonomous systems, with the vehicle business no longer the primary argument. Canada's two-sided exposure. Canada's market divergence from the U.S. reflects the country's position as a net oil exporter, but that structural advantage is now running alongside serious vulnerabilities. The TSX posted gains in sessions where U.S. equities fell, as energy producers benefited from elevated crude prices. Suncor disclosed 400,000 barrels per day of untapped oil sands capacity, a strategic reserve that becomes more valuable with every week the strait stays closed. Canadian gold miners committed to the largest capital programs in years, betting that geopolitical instability and monetary uncertainty persist through the decade. Yet the same week delivered a trade deficit more than double analyst forecasts, driven by record-high imports. Canada's manufacturing PMI touched its weakest reading in 3 months, with new export orders falling as U.S. tariffs on steel, aluminum, and autos continued their second year of impact. Canadian banks are reporting mortgage delinquencies at their highest level since 2015. The Bank of Canada released deliberations this week stating members would rely on judgment more heavily than usual, and admission that its models are not producing reliable forecasts. Forward markets now assign an 80% probability that the policy rate rises to 2.75% by December, even as the growth outlook deteriorates. Both the TSX energy trade and the tightening financial stress are present simultaneously, and they resolve in opposite directions depending on a single variable. The week's most important number is not Brent crude's closing price. It is the $32 spread between futures and the physical spot market. That gap indicates traders are pricing a diplomatic resolution that has not yet materialized in the physical world. The weight of evidence leans toward a prolonged period of elevated energy costs and compounding inflation pressure, not because resolution is impossible, but because the gap between Iran's stated demands and any politically viable U.S. response is structurally wide, and the labor market was already freezing before the shock landed. That lean holds only if the Hormuz closure persists through mid-April, when strategic reserve releases begin losing their buffering effect. If genuine ceasefire terms emerge with verifiable strait reopening, energy costs retreat, the Fed regains room to move, and the labor freeze could resolve as an uncertainty-driven anomaly rather than a structural break. Both scenarios are live. 2 benchmarks to watch next week: the March jobs report, which provides the first full month of hiring data inside the energy shock, and the Brent futures to spread. If physical prices start converging downward toward the forward curve, the diplomatic signals are gaining ground in the real economy. If the spread holds or widens, financial markets are still ahead of the physical reality.